Thank you for watching this video. I'm Jess. I'm a CFA candidate, and let's start. We jump deep dive into the CFA studies. Let's study together. First, I would like to read about CFA studies syllabus alternative investments about the introductions. And alternative investments are grouped together not because they have similar features, but instead because they have characteristics distinct from traditional investing. And investing in alternative can be done through the fund investing, the core investing, or direct investing. The alternative investment typically offer the investor greater diversification and higher the expected returns than traditional investment, but often involve the longer terms. The illiquid investment in less efficient markets invest in alternative requires specialized knowledge. Alternative investments typically rely on more complex and richer compensation structures than traditional investment in order to better align managers and investor incentive over the longer periods. The learning module overview. The alternative investments are investments other than the ownership of traditional asset classes, the private equities and the fixed income instruments, and the cash. That include the private capital, the real assets, and the hedge funds. Private capital includes the private equity and the private debt. Real assets include the real assets, infrastructures, and natural resources. Hedge funds may invest across both traditional and alternative asset classes and are distinguished by their investment approach, which often includes leverage, the derivative, or other strategies. Investors often consider alternative investments in pursuit of greater portfolio diversification and increase the expected returns. In doing so, that usually face the longer investment periods, reduce the liquidities, and less efficiency markets than for more traditional assets. Alternative investment fund investors fully outsources the control and management of investments in exchange for relative higher fees, while core investment and direct investment methods involve greater investor effort and control over the selections and management of assets in exchange for relative lower fees. Another common type of alternative investment structure is a limited partnerships in which responsibilities are flexibly allocated between the investor and the managers, with managers and the general partners and the investor as a limited partners. The limited partnership usually have more complex compensation structures, which include both the management and performance fees. And additional alternative investment structures include the trust and limited liability company. And what is alternative investments? Alternative investments are investments other than ownership of public equity securities, fixed income instruments, or cash that represents the more traditional asset classes. These investments are referred to like alternative to traditional asset classes because of their characteristics and the way they are structured. The investors are often attracted to alternative investment when seeking the greater diversifications and or higher expected returns in exchange for what are often longer terms, illiquid investments and in less efficient markets. And the features of this investment necessitate specific skills and information to evaluate their performance, and including the unique factors investor must consider if adding them to a portfolio. Alternative investment features and categories. Some alternative investment features are shared with traditional public debt and equity securities, while others are significant different features that may distinguish alternative investment include the following. The need for specialized knowledge to value the cash flow and the risks, and typically the low correlations of returns with more traditional asset classes, and illiquidity, long investment time horizons, and the large capital outlays. The features lead to the following alternative investment characteristics, like different investment structures due to the challenging of direct investment. Incentive-based fees to address and minimize the information asymmetry between the managers and the investor. The performance appraisals challenges. For example, while many alternative investments have equity or debt, the characteristics that often require a larger or longer financial commitment due to and like underlying the investment extend the life cycle or different the investment mentions and vehicles used to align the capabilities and incentive of managers. And investor over the time, unlike the individual securities, and the size and time of some alternative investments may also be prohibit large for certain investor. For this reason, most investors limit the alternative investment to that portion of their portfolio designed to fund obligations several years in the future. Sophistications, investors with the longest investment time horizons, such as the large pension funds, the sovereign funds, and non-for-profit endowments, tend to allocate a large share of their portfolio to these assets. Alternative investment categories include private capitals, real estate, and hedge fund. Private capital is a broad term for funding provided to the company that is sourced from neither the public equity nor the public debt markets. Capital that is provided in the form of equity investment is called private equity, whereas capital that is provided as a loan or other form of debt is called private debt. Private equity and private debt and are alternative investments with features similar public equities and public debt. For example, both the private and public equities investors are company owners, and with the residual claims to future cash flows and dividends. However, the investor in private equity may have full access to company information and latitude to influence day-to-day management and strategic decisions. Investors in public trade equity receive only the public available information, such as the annual reports and the periodic financial statements, with the voting right limited to decisions require a shareholder approval. The private equity refers to investment in private-owned company in public company with the intent to take them private. In general, private equity is used to mature the life cycle for firms in decline, with leverage buyouts being a key approach. Private equity managers often use the greater control and flexi of private versus private ownership to make management and strategic change, including the closing, the selling, or reorganizing lines of business to increase the profitabilities over a several-year period. Venture capital is a specialized form of private private equities, whereby ownership capital is used for non-public companies in early lifestyle and startup phase, where often an idea or business plan exists when a limited operations or customer base. So let's say have an example, venture capital versus the private equity. Hatfield Digital is like a early stage digital media venture established and 18 months ago. And Hatfield plans to convert the conventional music and art collections rights to digital form for sales and distributions. Its founders are seeking the early stage investor, and in order to conduct the market research, build the partnership and the initial operations. In contrast, Argus is a mid-sized manufacturing firm in mature industry that's experiencing a decline in profitability. Argus's share price has stagnated, and given its high cost structures and doubting the operating cash flow, Argusens lacks the scale to market necessary technology upgrades to maintain the competitiveness. A prospect private equity investor might consider an investment plan to restructure Argu's operations, acquire a smaller competitor, and or correct the efficiency, perhaps by updating the plant and equipment. In several years, acquisition may emerge as small profit independent companies and or as an attractive acquisition target for competitors. Technically, venture capital is form of private equity. The main difference is that while private equity investor prefer stable companies, VC investor usually come in during the startup phase. Venture capitals is usually given to small companies with huge growth potential, such as the Hatfield Digitals, and broader type of private equity financings would be more appropriate for a mature firm such as Augustin. And for private debt, in addition to private loans or bonds, venture debt is extended to early stage firm with little or no cash flow, while this track like that introduction like a separate fixed income license involve the public or private debt or corporate issuer believed to close to bankruptcies that could benefit from investor with capital restructuring skill. And when we come to the real assets, in contrast to financial assets, real assets generally are tangible physical assets, such as the real estate, for example, land or buildings and natural resource, but also includes such as intangible as patent, intellectual properties, and goodwills. Real assets either generate current or expected future cash flow and or are considered a store or value. Real estate includes borrow or ownership capital in building or land. Develop the land includes the commercial and industry real estate, residential real estate, and infrastructure. And commercial real estate includes land and buildings, where the private business activity is the primary cash flow source. Whereas the residential real estate cash flow stem from lands or mortgage, the payments by the households and public platforms of real estate include the real estate investment funds like REITs, which are issuers, the equity securities, and mortgage-backed debt securities, which are introduced and discussed in a fixed income lesson. Infrastructure is a specific type of real estate that typically involve like land, the building, and other long-life fixed assets that are intended for public use and provide essential services. The bridge and the tollers and a common example of tangible infrastructure assets. Infrastructures may be developed either solely by the governments or through private public-private partnership, in which private investor like also have a stake. For example, a public-private partnership might be used in order to attract the long-term private investment for a broadband internal investment. And infrastructure assets create the cash flow either like directly in the form of fees, lease, or other compensations for assets rise or indirectly by promote the economic growth and supporting the government's ability to generate increased tax revenues and the future economic activities. When the private investors are involved, the contract known as a consensus agreement usually governs the investor obligations to construct and maintain the infrastructure as well as the exclusive right to operate and earn fees for predetermined periods. And we look at the example two, public-private partnership for infrastructure projects in Indonesia. PT Indonesia's Infrastructure Finance is private national company established in 2010 by the government of Indonesia to accelerate and improve the private participations in infrastructure developments in Indonesia, together with the World Bank and the Asian Development Banks and other institutions. The IF provides the infrastructure financings and advisory service for commercial viable infrastructure projects. This approach has facilitated development of PPP projects, increased the equity investment in Indonesian infrastructure projects, and increased the institutions' awareness and capacity to implement the environment, health, and safety and social issues. Looking ahead, the infrastructure anticipates the need to spend 150 billion USD over a 5 year period to construct the power plants and toll roads. And while the governments will be able to fund the 30% of this cost, the remains will be financed by the private sectors through the PPPs. The natural resources involved either like less developed land, which is itself like source of economic value, or natural occurring standards products that are harvested, extracted, and or refined. And less developed land includes the farmland, the timberland, or land for explorations for natural resources deposits such as the minerals of energies. The source of return for this type of less developed land include the expected price appreciations over the time and the cash flow. For example, farmland generates the crop yield or agriculture's lease payments, and futures the timber harvest generate the timberland income, and mineral or trading rights to extract and refine the natural resources can provide incomes. In some cases, these investments may be considered like environment, the social governance purpose. For example, when promote the sustainable farming practice for like agriculture or create the carbon offsets for timberlands as the following example. Thanks.